Okay, welcome back to Infinite Investors, the home for all new and non-investors. I'm Curtis, and today got another investment video, and I'm gonna be asking the question: listen, is this the worst time ever to invest? Now, I know what some of you are like, and I'm a sensitive guy. So, right off the bat, I'm gonna tell you my answer to the question. But if you want to know why I feel this way, then obviously we're going to explore that during the course of the video. So, the answer to the question is that I do feel it is a bit of a challenging time to invest. However, I personally feel that we should keep investing just because you never know what happens in the market. However, what I will discuss in the course of this video is that maybe there are some better opportunities to invest at this current moment when there are signs in the economic landscape that I'm going to share with you, rather than other opportunities. So it's about basically deciphering what are the best opportunities. However, in terms of invest or not invest, to be or not to be, it's always to be with me. You've always got to invest, and that's my personal take on things. So that's my answer. Feel free to leave now, but if you want to know a little bit more, some of the context behind it, then obviously stick around. Please like, comment, subscribe, help the channel get to 4,000 subscribers so we can get the world of investing out to more people in a clear, simple and transparent manner. For those of you that are new, sometimes I'm just exploring the internet. I made a video about 14 stock market websites that I like to go to find analysis, research, tips, hints, interesting information. And The Guardian is one of those websites, especially their market section and their money section. There's a lot of really helpful information, particularly for UK investors out there as well. And when I find something that I do think is of interest, that I do think is very topical, that you guys are going to benefit from, then I will just share that article with you. So the link will be in the description. You can go and read this article yourself, but obviously what I'm going to do in this video is talk through the article, give you my commentary and my thoughts and feelings on the different sections, which is the reason why the video will be slightly longer. And then obviously I'm going to talk to you about my feelings overall about investing and what things I'm going to personally do. So let's get into it. This article is by Patrick Collinson, so this is his thoughts, feelings, his views. But I will say that I do echo a lot of the things that have been shared in this article. So we start. Shares are shockingly expensive. Wall Street rose by 29% last year as the market entered its longest running bull phase in history. The biggest stocks, Apple, Microsoft, Amazon and Alphabet, which we talked about in my last portfolio update, are now worth $4 trillion, 3.1 trillion pounds. Only 14 countries in the world have a GDP that is bigger than Apple's market capitalization alone. Amazing. That is crazy. Some stocks have seen gravity defying increases. Tesla made just 365,000 cars last year, but at $85 billion, its market value is now more than Ford and General Motors combined. We talked about that. And they sell about 14 million cars a year. The valuations on US equities are eye-watering. If you judge company share prices in relation to the profits they make, then on only two other occasions in history have Wall Street stocks been this high: 1929 and 1999. No prizes for knowing what happened next. Well, I think 1929 after was the Great Depression. Please someone tell me if I'm wrong. And I think after 1999 was the dot-com crash, which everything went down over 50%. So basically either recession or depression, which is, significant economic events that affect everybody. Bonds are no better. The UK government is 1.8 trillion in debt, yet it is able to borrow almost as much as it likes at rock bottom rates, large up Rothschilds. A government bond gilt that matures in 2071 is locked in at a coupon interest rate of 1.21%. If you buy it now, you are guaranteed to get just 1.21% a year for the next half a century. Ugh. Yuck. Even in the Victorian era, when inflation was lower, gilts typically gave you about 3 to 4% a year. As financial advisor Jason Hollins of Tilney says, those numbers are almost preposterous. At no point in financial history would that stack up. Fully agree. So shares are too pricey, bonds are rubbish. What about other major asset class? Property. Well, how disappointing to see Halifax report this week that house prices surged in December to finish the year 4% higher than the start. The average UK house price is at an all-time high of £238,963. It's highly unlikely prices will crash. But like shares in the US, if you're buying a house now, you are paying top dollar. We will have to return to the quaint idea of treating houses as homes, not investments. Listen, I do get the whole concept of houses as homes, not investments. If you look in economies like Germany, if there's anyone from Germany in the comments, please get in the comments and validate or tell me that I'm chatting absolute rubbish. But in places like Germany, they don't really see houses as investments. So you'll find like across Germany, across Austria, they see houses as a place to live. So majority of people rent, and when people buy a house, they buy a house to live. They don't buy a house from an investment standpoint. Whereas in the UK, we tend to see it a lot more from an investment standpoint. Don't get me wrong, there is a majority of people, there's a lot of people that their goal is to buy a house, their family home to live in. And that's perfectly fine. And that's, what it's there for. But there are a lot of people that see it as an investment opportunity. When you look at the amount and volume of international investors that buy properties in the UK, think about all of those apartment blocks and apartment buildings in central London, in loads of places, not even just central London. Most of those are owned by foreign investors, by corporations that aren't even in the UK. You will never have, Bob the landlord or Gerald the landlord or Leroy the landlord coming to your corporation or your building basically collecting rent. Most likely it's going to go to a trust or to a fund or to a corporation, to a holding company. And they're basically managing it for some offshore investors. So I think there is a big point here about property within the UK seen as an investment more than, its purpose for a house. However, if you do see it as an investment, then it going up 4% on a yearly basis, if that was it on average, isn't a bad thing. So that's what I think actually from the property standpoint, it's okay that it goes up. And I don't think that means it's a bad time to invest in property. I expect property prices to rise. Even if you buy your own family home, you're going to downsize in 50 years. You'd want to make sure you get a return on your investment, even if, it wasn't intentional. So I agree with that. But obviously, as a new investor trying to get into the property market, then it obviously can be a negative. Let's continue. If you think shares, bonds and property are just way overpriced, you can leave your money on deposit in a bank and get 0.2% for a year in a Lloyd's ISA. That way you are guaranteed to see your money fall in value in real terms after inflation. So we all know that savings interest rates right now, well, not right now, they've been like this for about 10 years. They've been horrific savings interest rates. Any type of everyday saver, most cash ISAs, anything that's really flexible so you can get your money in and out. But even some of those small fixed term savings cash bonds as well, they've not been great for, I would say, a good 10 years, maybe longer. And so obviously with the rate of inflation, which is on average about 2% a year, if you get anything less than 2%, then whatever money you save in cash, you're effectively losing money at the end of the day because the price of goods and services have gone up. So you always have to look at money in relation to everything else. Money in isolation is not meaningless, but it doesn't give you the full picture. But in relation to, say, another metric, product, asset, then you can actually start to understand the true value of money. Meanwhile, economic growth is stubbornly low across most of the developed world. The UK economy may expand 1.5% this year if we're lucky, and Germany even less. Productivity is lousy, consumer confidence is poor, and Brexit uncertainty hangs over everything. Can I be a bit more cheery? Yes, you can. Well, the UK stock market is now cheaper than at any time since the 1970s if you compare it with other markets in developed countries. Of course, that could just be telling you that everything else is madly overpriced rather than the fact that the FTSE 100 is a good buy. However, we don't know, but I'm going to be talking about, what I really think about that. In fact, let me just talk about it now. I think the UK is a fantastic buy right now. I'm looking at the stocks in the UK. I'm looking at valuations for UK businesses. And I personally feel that the UK is probably one of the best buying opportunities in general. I think when you look at the FTSE 100 ETFs, any FTSE 100 ETFs such as, say, ISF, the returns on the FTSE 100 ETFs versus the S&P 500 ETFs, you can see a complete stark difference. Let's go to just ETF right now, and let's do that. Let's do that just to make sure that I'm not, chatting wasp. But as an example, if I go to ISF, which is iShares Core FTSE 100 distributed, you will basically see, if I click on it and then I go to returns. Hope this is not the heat map screen. Come on. All right, cool. Yeah, if I go to returns, you can basically see 2020 so far is 2.3%, 2019 17.5%, 2018 minus 8.78%, 2017 11.91%, and 2016 19.9%. And if you want to look at it in periods, 1 month 1.8 through to 1 year 15.72, so to speak. Now let's compare that with IUSA, which is probably the equivalent, another distributed iShares ETF, but tracking the S&P 500. You can actually see the figures are astronomically different. You've got 4.27%, what was it, 2% so far for the FTSE 100, 27.07%, I can't remember where it was, but it was mad higher. That year, the FTSE 100 loss, remember it was like 8.7 something percent as a loss, 0.61%. So again, that's about a 9% difference. 10.49% and 33.96%. And then in periods, the same thing. So you can see that the American market typically has done better than the UK market historically over the last 5 years. And so, you know, my feeling as well is that that's not always going to continue. And it might be that from a long-term investment standpoint that the UK is a really good buy at this current moment. Sterling also remains deeply undervalued and over the longer term should appreciate unless Boris Johnson engineers the worst of Brexit outcomes. We shouldn't put it past him. The good news, Donald Trump faces an election this year, which is good news. And we can probably safely rely on him juicing up the market in whatever way possible. One thing I've noticed is that, you know, conservatives, Republicans, I'm not going to get into the politics of it, because that's not what I really want the channel to focus on, but I will get into some of the trends and behaviors, is that any politician or any party that is very capitalist focused or very focused on the rich getting richer, you will find that as an investor it will benefit you. So it might struggle, it might be a tussle with, you know, your morals or your ethics in other ways just because of some of their other policies and some of the other things that go on, but just typically think that the average working class individual does not invest. Just like understand that the average working class individual doesn't even save any money. To be honest, the average working class individual is in debt. So typically when they're looking at politicians and what they're saying and their policies, those policies really tend to have a squeeze on their finances rather than help their finances. This is why I encourage everyone to get an emergency fund, why I encourage everyone to really try and strip down your spending, why I encourage everyone to actually start to get cash. Once you get some cash, I encourage everyone to start investing, because if you save and you have, say, Labour in party or the Democrats in party, then you'll still have money anyway. You'll still be doing well anyway. But then if you have, say, one of the other parties that's more capitalist focused, more rich getting richer focused, more, you know, shaving tax for corporations focused, then as an investor in those businesses, in those corporations that save money on tax, as an investor in the stock market, you are naturally going to benefit from their policies from a financial standpoint. Obviously from, you know, any other standpoint, maybe it's foreign policy, maybe it's educational policy, maybe it's, you know, criminal policy, whatever it is, you might not have a benefit, but I'm just talking purely finances, it tends to benefit in this situation. That's why in this context, it can be seen as a good thing if Donald Trump was to get re-elected, whereas in other contexts, it can be seen as a bad thing. I hope that makes sense, but if it doesn't, get in the comments so we can talk it out. We can probably safely rely on him juicing the market in whatever way possible. So selling out much before 3rd of November could be a mistake. Selling out US stocks much before the 3rd of November, so right up until the end of the year, could be a mistake. This side of the Atlantic, Boris will be priming the economy as well. If the promised end to austerity and infrastructure projects actually materialize. Right-wing economists hate public spending, but stock markets initially at least tend to love it, as I mentioned, as it turbocharges corporate profits, as I mentioned. Think cement makers, construction companies and so on, but also when there is a reduction in corporation tax, when there are these companies that don't pay, do you know what I mean? It tends to have a benefit from a valuation and a stock market standpoint as well. It's just the way the money system seems to work. In more than 30 years of financial reporting, one thing I've noticed is that when asset values look stupidly overpriced, like many do now, what happens next? They just get even more stupidly overpriced. I sense we're in the giddy phase of the bull market where prices keep defying gravity. So I do think we're in this, that's basically a bubble. That's the way I personally see it. It's a bubble. When we talked about the inverted yield curve last year, and we talked about there was two instances of it, and then we looked at all historical inverted yield curves, and that basically suggested that within 14 months of the first or the second yield curve, we would be hitting a recession. I would then forecast that by the end of this year, early next year at the very latest, is when we were meant to hit a recession. If we go past January 2021 and we haven't gone into a recession, then mate, I don't know what to tell you. Science, data, economy, history, past performance, it's all wrong. And we'll soon find out what's going to happen from that standpoint. So we are in a bit of a giddy phase. I do think that with some stocks, that means you should be a little bit more cautious. And like we talked about the Warren Buffett quote, when people are greedy, that's the time to be fearful. When people are fearful, that's the time to be greedy. So that could be the time to start selling up some of your holdings, maybe not all of your holdings, and reinvest into some safer things. However, obviously, we can never time the market. We're never going to really know when this bull run is going to come to an end. So despite the scary valuation figures, it probably isn't the absolute worst times to invest. I'll stick my neck out and say the FTSE 100 will probably sell through the 8,000 level at some point this year. That'll be interesting. That'll be good to see from a FTSE standpoint. I do think a lot of the strong UK businesses are going to do well this year. I personally believe, since the whole Brexit. I mean, Brexit obviously still is a concern, but it's not as much of a concern as it was, throughout, the tumultuous 2019 that we basically had. The other truth about markets is that almost nobody gets timing right. Truth. And missing upturns is as risky as avoiding falls. The boring rules still apply. Have a diversified spread of investments, hold for the long term, and avoid high charges eating your returns. And if you want a tilt at playing the markets, then maybe this is the year to buy British. And that I fully agree. You guys seen my 2020 vision. I've got the dip pillar, I've got the drip pillar, and I've got some cripping alternative investments, which I might have to rethink because I'm not doing much in that space at the moment, nor can I see myself doing much in that space, but it's only 10%, so we're going to move on. However, in the drip pillar, I'm all about UK undervalued stocks and business, and potentially US ones, but definitely I'm buying British from that standpoint. And I'm obviously getting those dividends in. Last week I spoke about my portfolio update, how well Taylor Wimpey have done in my performance. I spoke about how a lot of my financial stocks have started to drop, which I think is an amazing thing because it means I'm going to get share prices cheaper, and most of those start paying the dividends in and around the April mark. So if I can get more shares of those businesses now at cheaper valuations, not only will I hopefully benefit from a capital gain standpoint, but obviously I can increase my dividend yield and my dividend return, which I can then obviously reinvest into more things. And me personally, the US market right now is looking a little bit scary. I can't lie, it's looking like a horror movie right now. Not a horror movie, but a stock market horror movie, like a parody horror movie, where it's funny, but it's still scary at the same time. Because at the end of the day, if the US market with some of those stocks, like probably a lot of you may never have experienced, a 50% drop in a couple of days, a 49% drop, a 35% drop, a 65% drop. If a recession, etc., was to hit, those are the types of drops that you guys can be expecting overnight. Do not think that you can time a recession and think a few news headlines and then, I'm going to be able to time it. You'd have to time it with a lot of buffer, because it can literally, things can change at the drop of a hat. And it is something to definitely be mindful of. And so one thing I will say for myself personally is that I've got those US stocks. I'm going to continue to buy US tech stocks. I do agree with this whole Donald Trump November the 3rd situation. And plus, I believe in actually the businesses that I'm buying. So not just the macroeconomic landscape, but I actually believe in those businesses. I believe in Uber. I believe in Shopify. I believe in AMD and so forth. And we always have said, fundamentals from a growth standpoint perspective doesn't always dictate the direction that those stocks are going to go in. But what I will say is that I'm going to definitely focus more on keeping up my investments, whether it's spare change, whether it's dollar cost averaging into my UK dividend stocks. And I'm really excited to get those numbers up as much as possible. And the great thing about those stocks is I just don't care what direction they go in. I don't care if they drop 20%, I'll still invest. I don't care if they go up 30%, I'll still invest. Whereas with some of the US stocks, I actually care what happens to it, because then I have to make certain decisions. So I think the thing for me to basically, share with you guys here is that right now we're in a very, very interesting time. I think the US is overpriced, so it's definitely something to be concerned about. I think bonds, savings accounts, you're just not going to get enough for your money, but definitely have cash and definitely have your emergency fund and definitely put cash away just in case you even need to draw on that to invest in an opportunity, or you need to sit on that just in case, you know, your stocks or anything actually starts to drop. I think property, from my standpoint, is just buy it whenever. If you find the right property at the right price, just buy. Me personally, I don't think it's something to, you know, I'm going to wait to buy property 2 years down the line. If you've got the money and you know what you want to buy, just get it. That's my personal take on property anyway. And then obviously, you know, let's see what happens this year when it comes to the elections, when it comes to Brexit, and what that's going to mean for US, UK, and obviously global stocks around the market. I hope this video was informational. If you did find it useful, please get in the comments and let me know if you like this type of thing where I just kind of do a little bit of a brain dump on some interesting articles, or at least I think it's interesting anyway. If you did, like, comment and subscribe, and I will catch you next time with another investment video.